Ready to rock and roll?
Let's roll, baby.
All right.
Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
Greetings and welcome to the About podcast, where we talk about all the things that matter, especially when it comes to your finances and financial health. As always, I am Jeremy Scott, host, and I'm joined again, as always, by Roy Hookey. And today, I believe our topic is to talk about life insurance, which means we get to talk about things that nobody actually wants to talk about,
100%.
which is why you buy life insurance. And disclosure from the beginning, this has been an active part of my life recently. So I'm actually grateful for the conversation, Roy, because I'm sure it'll come up in our conversation. But I remember the conversation you and I had about 2 years ago about this topic. So, but I don't think I think life insurance for a lot of people might just be more of kind of like a nice to have, or something maybe you purchase through your workplace, or but there is a little method behind the madness about figuring out about, what kind, how much, right? Like, can you have too much? You certainly can have too little, things like that. So why don't you start by just giving us a primer about, life insurance in general. And there's a couple of major kinds that you will often run into out in the marketplace.
Yeah. I'll probably start with you brought it up, which is nice, through work. So you really have what they call group insurance, or you can have your own personal policy that you personally own. That's a big differentiator that exists in the marketplace. One usually goes with your job.
Okay.
A group insurance.
Group insurance.
You are grouped in with a bunch of people, and they usually have some sort of fixed numbers built in because they know that in a group of people, you're going to have some bad apples that could potentially cost you money, but then there's also some people who they know are going to be good apples and aren't going to really cost them anything, right? So they kind of balance each other out. So that's important to understand. And then,
so that in that case, it's not unlike like group health insurance you might have through your employer too.
It's very similar in the methodology.
That is, you're grouping together, right? Like you may have somebody who never goes to the doctor. I never use my health insurance, and then you got the other person who gets cancer, and then uses hundreds of thousands, and by pooling together, it hopefully works out in the end.
The really nice thing about group insurance is it's really inexpensive.
Yeah.
But it actually is deceptive, because group insurance is actually like a stair step, where when you reach certain ages, it's usually every 5 years, but if you actually look at your work, you can actually get a schedule of this to see what their policy actually says.
Oh, okay.
Nobody ever does or even knows exists.
Can't say I have.
But it will step up, and the older you get, and if you want more insurance when you get older, it'll cost you a lot more in your life arc, if you will, right? So if you bought a personal policy that you paid for outside of work that had a level premium, it would be actually cost you less in the life arc, that 30-year period, let's say.
Oh, okay.
Versus your work policy at that 30-year period in the same concept,
because it's going to keep stepping up.
Exactly.
Yeah.
So that's something that's really important to understand, because it's actually a bit deceptive. Because today, let's say you got a 25-year-old, worker, and they could get a term insurance policy through me, which is, we'll get into the term and permanent, but here in a second. But it's a very low cost option outside of work that they have with me. Mm-hmm. But their work policy through the group policy that they have an opportunity to buy through, they're going to be less expensive there than even I can get them today at 25. A lot of the times.
Right.
Very rarely do I say I can beat it, which is deceptive, because they're like, well, I can get it cheaper through work. Kind of.
Right. For now.
For the next 5 years, 10 years maybe, but then at a certain point, it would have been smarter to buy your own.
Right. Okay.
Also,
because eventually it's going to become more expensive.
Exactly.
Okay.
More expensive, but also it's not portable. Portable meaning I can take it with me if I change jobs. Do you know anybody that stays in the same 30-year job at this point in time?
I have not very many of them. I am certainly not one of them myself, but I have not met very many people who actually do that anymore.
It's really not a thing almost anymore.
No.
If you're not changing jobs, you're not doing it the right way, because they say you're not getting enough raises if you're not changing jobs, because if you stay somewhere, you're going to get the same pay. Anywho, that's another conversation. But group insurance versus personal insurance, that's one form. To be educated on that is an important piece of the puzzle.
Sure.
Okay. I just referenced earlier term insurance. Mm-hmm. And if I own a policy that I hold and I own it and I can take it wherever I want, however I want, I can own it through term insurance or a permanent insurance policy. Okay. Term is like paying rent, right? I'm paying rent, I'm paying my premium, but it has a period of time connected to it. A term.
Right.
Could be 10 years, 20 years, 30 years.
So it's not just a fancy name.
Just not a fancy name.
Okay.
But at the end of that term, if I didn't die, yay, I didn't die.
Which is the goal.
Right. And I paid off my debt and hopefully saved some money along the way. But that policy could potentially be gone.
Right.
After that term is up.
Right. There's no residual value. It's like, well, in that case, not to keep making comparisons, in that case, it's like car insurance. You have car insurance, you don't get into an accident, you don't run into anybody, nobody runs into you, you don't have to use it. Your car's in great shape,
Thank
great
goodness,
for you.
Right. Thank goodness I didn't use it, but the money's gone.
Yeah, but now, it's gone.
Yep.
Yeah.
Yep. So that's kind of term insurance. Permanent insurance is a bit different, meaning that there's different types. The number one is whole life.
Mm-hmm. I've heard of that
Most of everyone's heard of whole life.
Yeah.
There's variable universal life, VUL for short, or there's universal life. Let me paint you a picture.
Whole versus universal. I'm intrigued, Roy. Whole versus universal.
Right.
Okay.
Yes. We're not Star Trek here.
Okay. I was like, wow, this is getting kind of spacey.
So if I do a universal life policy, let me just kind of start with that one.
Yeah. That's good.
It's a permanent product that typically does not have a very good cash accumulation option over the long term.
Okay.
All right. So think of that term policy I mentioned earlier. It has a level premium that doesn't change over the life of the term. I don't know if I actually mentioned that, but it does. The term policy has a level premium that doesn't change for that term.
So I buy a policy for 10 years. It costs X dollars a month. It's going to cost X dollars a month. The first month's going to cost X dollars a month. The last month of the 10 years.
Correct.
Okay.
A universal life is like term in regards to it. It will be a level premium, but it will just continue
as long as I keep paying it.
Correct.
Okay. So
it's a little more nuanced than that, but let's just say that's as far as we're going to go for the purpose of this conversation. But there's different types. There's guarantees, blah blah blah. Anyways, but it just goes on as long as you pay the premium.
Okay.
And the policy is what we call healthy.
Okay.
Okay. But not very good cash accumulation. Keep that in mind, right? So you're really buying it for the death benefit, and that's it.
Right.
Okay. Variable universal life. Same concept, except now part of my premium is probably a little bit higher, and a good amount of that money is going to go into mutual funds that can own investments inside of the policy.
Okay.
And potentially grow a pool of money.
Oh.
Okay. Now, there's always times where you could have it not grow or perform poorly and all that stuff.
Sure.
That
The market's the market.
Right. And again, there's some guarantees in that world too that exist, but broadly, it's a pool of mutual funds that have a life insurance wrapper around it that have the opportunity to grow in value. And if it grew big enough, you could potentially not pay premiums in the future.
Oh.
Or just have a higher death benefit.
Oh, okay.
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 So that's a variable universal life.
Okay.
Okay. And then whole life. Whole life is risk being assumed by the insurance company. So what the insurance company tells you is that, hey, you buy this whole life policy, we're going to give you a certain return on what they call dividends for the company. It really is based on the underlying performance and health of the actual company that underwrote it.
Okay. The life insurance company.
Right.
Okay.
And how profitable and how good they do and where interest rates are at. So it has some parameters that play into it. But the risk is less on you and more on the insurance company. So it's the most expensive kind of insurance.
Oh, okay.
Okay. Because it's going to be there. It's going to have a cash value of some sort. It may perform really well or it may perform poorly depending on the underlying performance of the company that you bought it from. There's some other nuances, again, to that whole thing, too. It's not as simple as I'm saying here, but broadly, you have those three types of permanent insurance. Okay. And the cost is highest with whole, a little bit less with variable, and then usually the least with universal life. Okay. So that's a permanent product, though, that you own, like buying a home. So people who buy that typically are people who want to make sure that they have a death benefit no matter what happens.
Right.
They want to do some legacy planning, meaning, I've got 3 grandkids and, my kids over here, they're getting this house and this land or something. And I'd like to leave something to my grandkids so they can pay for college. And I'm buying this life insurance that they can split 3 ways and it's going to pay to them. And that's a legacy planning type thing.
Right.
That makes sense?
It does. A
lot more ways to use insurance in a positive way because it is tax-free as long as you're under the IRS minimums for your lifetime exemption on estate taxes.
Mm-hmm.
ESTATE, estate, not the state.
The state. Estate. E-state.
So there is a situation in some very rare cases where you could actually have your life insurance be taxable. Right. That's a misnomer that people don't understand too, that it's always tax-free is not the actual truth. Most of the time it's tax-free, but there are cases where it's not.
Right. For most of us who are going to leave behind normal-sized estates in terms of like dollar value, then chances are.
Well, in today's dollars, it seems that way, right?
Mm-hmm.
I think, and I don't know the exact number. I just heard an attorney say it. It's 11 million-ish range.
Okay.
Right now per person.
Oh, okay.
So a married couple is around 22 million roughly.
Yeah.
That they can give away over their lifetime and not as incur an estate tax.
Okay.
Well, honestly, politically, depending on what happens in the government, you could actually potentially have that be cut in half. Right?
Yeah, that's one thing they're always arguing about, right? Estate taxes.
Yeah, because they want to tax everything they can, it seems like, right?
Well, everybody's got to make their money.
Right? So anywho, the money that they can tax on that is going to be used, obviously, towards the debts and whatnot that we're incurring. So, but that, that number being cut in half at $5.5 million, $11 million for a couple in today's round numbers, that's going to affect a lot more people.
Right. Well, yeah. I mean, especially with the home values, the way they're going and everything. Yep. I mean, it's people. I think you can accumulate more than you know. I mean, I think people like really kind of sit and think like, oh, if you add up the value of your investments and your retirement and your house and, all this sorts of stuff, I mean, the amount of accumulated wealth someone can, who makes a reasonable amount throughout their lifetime can accumulate actually, especially if they're in any way smart with their money and, then, it can be significant.
Yep.
And if you're a small business owner, if you've got anything like that going on, that those accumulate value. Which is good.
Yep.
You want it to.
So, and homes and land are probably the biggest way where you can kind of get caught on that. But, point is, it's just when you have inflation like we've had and you have the valuation of your property, assets, whatnot go up like they have, it could get there easier than you think.
Right.
I do a retirement analysis for a lot of people, and I was just meeting with somebody the other day, and the numbers were pretty big, and they're in their early 30s, but they're saving aggressively. Mm-hmm. And they would have an estate problem if those numbers were adjusted today.
Oh, okay.
In half, like we're talking about. They would have an estate tax problem.
Yeah.
So, normal people.
Yeah.
Just working hard, saving hard.
Yeah.
That's all.
Right.
Yeah. So anyway, so that's all part of this world that we have to use, and actually, what sometimes people will use is life insurance to pay their estate taxes. So the uber wealthy, let's say that they had, let's say it was 11 million and they have a $12 million estate, whatever. Well, a lot of times it's in illiquid assets. So they have to sell the ranch or the farm. Right. They don't have that money just laying around to pay their estate taxes. So what will be done is on the amount of money that's over the lifetime exemption, we'll buy life insurance to pay the tax bill.
Yeah.
But how, you might say, when that's taxable if we add it to the estate? Well, there's ways that we add it to outside the estate.
Okay.
Which we won't get into. But there's ways to do that so that we can try and pay that tax bill and not incur an additional tax problem.
Right. But that'd be the advantage of something like a policy, like a whole life or something, or that has a benefit.
You would want it to pay for sure.
And so if you know what that goal number is, that or what about you're aiming for. Okay.
Yep.
Okay.
So
leaving it by for as intentional inheritance purposes is interesting. I think we all try to want to leave something behind, especially if we have kids or grandkids. We want to leave something behind, but to really think about some intentionality around what that looks like. I know when I think about health and life insurance, especially where I'm in my life, I think about it more in terms of like, catastrophe protection, right? Like something unexpected happens at a time when, my spouse or my children are especially vulnerable. I want to make sure they've got, something available to them to keep, keep going, right? And in my absence. But there's another way to think about it, which is, we will all someday not be here, which is the part of the conversation people don't want to have. I mean, even in my world, like, people are not keen to talk about the fact that they are in fact going to die someday. No. But there is a conversation about what do you want to leave behind, and hopefully you've saved and have something to leave behind. But the idea of a life insurance policy as an investment specifically to leave behind to those you love, to take care of something you care about, even at the end of a rich, full life, which we all hope to have, versus more like the catastrophe protection. Because when I think of like my term life policies that I carry, that's what I think about them for, is if anything happens to me and I step outside and get hit by a bus, right? My children are not going to be destitute.
Yep.
Right. They will have enough to get them through school and, launched into life in the way that I would have hoped to be there to do them myself, but I'm not thinking about, frankly, at this point, when I'm 85 and, have lived a good life and I got kids and maybe great grandkids or whatever, leaving behind something there that's feels like a different thing.
Yep. And usually it starts with that catastrophic insurance conversation, right?
Yeah.
So, I mean, anybody who owns a home, is married, has kids, you probably need to seriously consider looking at life insurance for your situation just to see if it makes sense or not. And term insurance is a lot of times what's used because it's more affordable, right? This is just less expensive, and that just makes more sense, right? And if you needed a 10, 20, 30-year policy, you can get, anywhere in that range of coverage. So term insurance is probably the number one, but hardly, it's funny, it's probably number one sold, but it's the least paid out insurance.
Yeah.
Yeah. So, which is good. I mean, it means you're not dying, right?
Right. Well, I mean, it's cheap for a reason, right? Because people,
yeah,
most people are not going to actually use it. But I mean, for me, there's still value there. There's value. There's the sleep at night thing.
Oh, totally.
Right. It's like, okay, I know that, there's a little something out there. And when I was we talked about estate planning and all of that in one of our previous episodes, and when I was setting all that up, I'm like, okay, like there is something in here. Here's where it is. And God forbid anybody needs it, but it's there.
If you have it, nothing's going to happen.
Yeah. Well,
that's how it works.
Not quite. But yeah.
So term is a lot of time asked, why do we get term? How much should I get, are a lot of the questions that I get from clients. And a lot of times it's just walking people through like, okay, well, let's go through your debts. Oh, we got some school debt. We got home debt, maybe a little bit of credit card debt in some situations. Well, we want to wipe all that out in the worst case scenario and something happened to you, right?
Right.
But I also tell people there's something else beyond debt that you should consider is, the income replacement.
Yep.
For potentially a period of time. You lose someone that you care about. Last thing you want to know, as you well know, is I don't want to worry about my job.
Right.
I don't want to worry about my paycheck. I just want to survive. Right. And that's income replacement. So that just depends on what people need or think they want. A lot of times I'll have a husband and a wife, and one of them will be the higher earner.
Yeah, usually. Yeah.
And one of them is less. Well, if you have the higher earner versus the lower earner, that might be a different conversation on how much coverage is needed, right? But then beyond that, a lot of time people don't think about the savings potential that you lost, right? Just for retirement savings.
Yeah.
That sometimes people want to build in because you can build in the real-time value of that and have it be a much smaller number today. Something, God forbid, happened that can turn into that lifetime savings that person would have saved.
Right.
So those, and sometimes that just comes down to the affordability of it too. Like we can have the conversation, we need X, but we go through the underwriting process and maybe we need to back that down a little bit because it's just a little too costly.
Right.
So.
Yeah. So for me, like the term thing makes a little more sense. It's a little more clear cut. Like I can think, okay, my kids are this age. I'm hoping by the time they get to, their mid-20s or whatever, that they're pretty much on their own and they're able to stand on their own and, all that kind of stuff. And as a single parent, like that's my big concern is right now them. And so I can figure like, okay, well that's, for my youngest 10 years, 12 years. And I'm like, okay, what do I need to make sure I've got? And then so that for me, like that is a term, right? And like, what do I need to do,
Yep.
there? So that feels fairly straightforward. I think in a lot of people's minds that is fairly straightforward. The other ones, the what you talked about, the whole life and the universal products, again, those seem to have a different function. Is there a kind of general rule of thumb about like when to think about doing a whole or a universal or
It honestly comes down to, think of it like buying a car.
Okay.
Do you want the budget-friendly car, or do you want the one that's really quite nice and really got the bells and whistles?
Well, I'm a car guy, as you know. So and it's like,
so it comes down
never.
It comes down to a cash flow thing typically.
Okay.
Right? So if you have the cash flow to pay for the house, the permanent product, maybe that makes sense for you to do that, because you know that you're not just kind of throwing it at the wall. Right. We know we're going to have a payback to your family. Someone you care about is going to get that payout.
Right.
Right. Or if you live till your 80s and it has a big fat cash value in there, you could actually potentially, pull money from it, take a loan from it, do different things. It can have tax consequences to do that, but that's part I educate people on before they do it.
Right.
But so it has more of that multi-purpose approach.
Yeah.
Where I can take money out of it later if I wanted to, and I don't need it for the life insurance benefit.
Okay. So, I mean, obviously, if it's a permanent product, it will eventually pay. I mean, if you keep paying, I mean, it's like, then it will eventually, because again, we're all going to get there.
Yep.
So does the benefit that it pays change over time? Is that part of it?
There's different types of products that can have an increasing death benefit. Those do exist. So it honestly just depends on what we're trying to get and for what purpose.
Okay. So with most people, would they have like a mix, like a a term to cover that, and then and a permanent?
Yeah, actually that's a very real thing. When you're younger in life, maybe you can afford that term plus a smaller permanent policy.
Right.
Right. Because the goal is, after I pay my mortgage off, what's the biggest debt I have? Well, your car, maybe, right? Maybe some student loans if they're out there.
Right.
So that disappears in time because your biggest debt disappears, but you now have a smaller permanent coverage that's going to continue on because it's for that legacy planning. It's for income replacement for your loved one.
Right.
It's, whatever. They want to have a party at your, funeral, whatever.
Right.
I mean, it's for them to do whatever they want to do with it. But that stacked approach of having term and permanent is a real thing, and it is a strategy for some folks.
Yeah. Well, some of it depending on your wishes. I mean, depending on your wishes after you pass, like funerals and expenses around that, are not insignificant. Again, depending on what you want, but they can run into the many thousands of dollars. Final arrangements can be rather expensive, too. So even just stuff around that, being able to make sure you can, if something's important to you, right? If being in a particular place or, whatever is important to you, then, it's great to, as we talked about, and I think the estate one, leaving those wishes behind is important, but it also is nice to leave your family behind a way to pay for it because those can get, the costs are not inexpensive.
Yep.
So even things like that.
So when it comes to insurance in general, I always tell people, I'm not a pro or a con guy on this product. It's just, let's educate and let's see what is important to you, what your potential needs are, and then try to fill that void in a worst case scenario. And then if that makes sense, then we go with that. Right. But it's just a tool like anything else. But I'll have sometimes people come in with a predetermined, well, this is what insurance is. But it's just not the case always, right? But they had somebody who had a bad experience with it, and that's one of those things that we have to kind of re-educate people around that so that they understand, like, hey, unemotionally, this is a tool. Does it make sense for my situation, for what I'm trying to accomplish, or not?
Right. Well, I wonder if sometimes that's a part of it too, because I will tell you the thing that I'm not a skeptic about a lot of things, but I mean, anytime I see anything that's like dominantly marketed, like through infomercials or, like in like 2:00 in the morning television ads, and there's so many like so-and-so whole life, blah, 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 and it's just like, it just feels a little like,
it's
and
like those gold commercials.
Yeah. It's like the gold commercials or
everywhere,
or I mean, honestly, you're like, like the buy here, pay here car lots where you don't realize you're paying, 200% interest or something, on it, things like that. I mean, there are people can have bad experiences, and there are bad experiences to be had, but that doesn't mean that the whole idea and concept, especially of permanent insurance, is necessarily wrong.
Yep.
There are probably a lot of scenarios where it actually does make sense.
Yeah, and it's been an evolution too of products over time. And recently, it's not really, I guess it's not that recent that it's occurred, but there's another product in the term world that they call it a convertible term policy. So what that allows you to do is with whatever company you purchase through, okay, that you can convert it from a term policy into a permanent product, and they can't decline you no matter what. They will age you, but give you the same underwriting class that you originally got underwritten at. So if you came in at preferred best when you were 25 years old and you converted it when you were 45 years old, and maybe you're uninsurable now because you have made bad lifestyle choices, whatever, they can't decline you.
Yeah.
And now you have a permanent product. It will be more expensive. It'll be aged to the appropriate age, but it's still in place.
Yeah.
And it still has the same class or underwriting class,
All
which
right,
is actually a really big deal.
That's a big deal. So that's a good transition into talking about underwriting, because I've run into this before for myself, just because of some of my medical history and where I've been and everything that I've, I don't have any problem with the group policy that's like, here's the max you can get without having a medical whatever attestation or checks or anything like that. And I always check that. I'm like, great, I'll take that. But yeah, underwriting is a whole other thing that I don't know that everybody quite understands, and that is going to play a role, obviously. I mean, and similarly, like if you are a driver with a poor driving record who's been in accidents and or gotten a lot of speeding tickets, whatever, you're going to end up, you're going to find fewer insurance companies want to work with you, and
Yep.
you're going to pay more in your premiums and all that. Or if you're just in a bad category, I think this is close to home because I got an 18-year-old on my car insurance policy right now, and I know what that did to my premium benefits, because 18-year-old boys are not as good. I mean, there's more risk there. So I assume the underwriting process is then that's the life insurance company basically trying to assess risk.
Yeah, they literally are using an actuary process, right? Actuarial process that can basically look at anything under the sun and tell them the risk, right? And every medication you could possibly take, any surgery you've ever had, any of that stuff is part of that. Your current lifestyle, right, is part of that. So are you going rock climbing every weekend? Stuff like that. I actually had someone get declined because they were rock climbing like at the extreme level, and they're like, this is a big risk to us. We're not going to underwrite you.
Oh,
You're a decline to us.
right.
Yeah. So
Interesting.
they had to quit rock climbing if they wanted to get life insurance.
Wow.
Yeah. So, I mean, if you do risky things, then they're looking at the risk and they don't want to take that risk. So they will say no if it's not a good opportunity for them. So when you do underwriting, typically you have a phone call from the insurance company, and they kind of go through a list of questions, and it's like being on a witness stand, right? You just answer truthfully and don't volunteer any other information. That's literally what it is.
Answer the questions.
Answer truthfully
in as few words as possible.
Exactly.
Yeah.
And then from how you answer the questions, depending on your age, they could potentially require a paramed exam, which is where they do blood and urine testing on you. Okay. And they usually send someone to your location. They'll do it, at your home or at your work site or whatever you wanted it to be.
Oh, wow.
So they make it convenient.
Yeah.
And then a lot of times, based off of that, it depends on the company, but they'll request your medical records. And there's a cost to all this time, people actually doing the work, right? So they try to do as little as possible. So they really have a robust questionnaire because of that.
Right. Oh, so they're basically triaging everybody ahead of time.
Yeah.
They're basically saying, is it worthwhile to send Joe out to your house to draw your blood? Because that's not going to be a cheap thing to do.
Right. Cost them money.
Yeah. Because if you're not going to buy a policy, then we just wasted our time.
Yeah. So for young folks, actually, they started doing this like rapid underwriting process where I actually had a policy in 2 weeks one time.
Wow. And that's quick?
That's nuts.
Okay.
That's nuts. To give you some perspective, I had the same type of product, term insurance. It just took 8 months. 8 months.
Wow.
And it had to do with medical records.
Yeah.
That was the problem.
Oh, okay.
Anywho, that's a big part of the process. So if they request those medical records, I always tell people it could take 3 to 6 months typically. 8 months was a bit extreme, but it was a goof up on understanding the location of where the actual medical records were at. They had multiple buildings on the same site. They were sending it to the wrong building and they were rejecting it. So
we don't know this guy.
It just created this disaster. But thank goodness we had a big celebration when that one was finally underwritten for those folks to get the coverage. But that's the underwriting process, right? So typically they'll come back with a class rating. So just think of it as like a standard rating is like I'm an average everyday American. Right. There could be that's called standard, and there could be a preferred, which is better than standard, and you get a little bit of cost savings for that, and then like preferred best, if you will, and that's the best underwriting class you can get.
Okay.
Right. So that's the world we want to live in is standard to preferred best. Right. But they do actually have what they call table ratings, which are worse than standard. Right. Table going under the table kind of concept, I guess.
Right.
I don't actually know where they got that from, to be honest with you. But it just means that they'll still underwrite you, but it'll cost you more than we had anticipated.
Oh, okay.
Yep. So when they come back with an offer, though, once they're done underwriting you, then we actually look at it and talk about it and say, like, okay, does this make sense? Are we going to get this? Do we need to reduce it? You can always go down once you're underwritten, simply, and they'll say, okay, no problem. But if you want to go up because you're like, oh, I came back preferred best. Well, now I want to go from 1 million to 1.25 million. They won't just do that simply because they underwrote your risk at $1 million. So they would actually have to send you back through underwriting to evaluate if you're worth additional risk.
Okay. So if if you're doing it,
go in high.
And
then reduce.
Yeah.
Yep. Yeah. Just so that you don't have to go through the process again.
Yeah. But not so high you're going to get rejected.
Yeah. I mean you have to do it within reason because they're going to look at you and be like, why do you want this much coverage? You want $7 million, but you make $70,000 a year and you have a house with a $300,000 mortgage. Why $7 million? And they'll be like, we're not going to underwrite you.
Oh, okay. Well, that was going to be a question I had, actually. Okay, yeah, like that.
There has to be a reason connected to it.
Right. Just because I want my children to be millionaires after I die is not.
They're not going to do that.
Yeah. That looks a little hinky.
Yeah.
So
they're looking at all angles. They're they're protecting themselves from the worst case scenario, and even when on the permanent product that will pay, they're making money on that.
Right.
Right. So they want you to live as long as possible because they get to make they make money every year off of you by having that premium.
Right.
And at some point it will pay, but as long as possible to them, they might be in the money.
Right.
Even if they had to pay out the whole death benefit.
Right. Because they're not just sitting on the money they take in. I mean, the insurance business model, as I understand it, is, they're paying in premiums, which you're doing, and some of that's being used for overhead and administration and everything they have to deal with. But they also then end up with this pile of money that they themselves, I assume, are investing and, probably, hopefully not inappropriately.
Depending on the product. Yeah.
But they, the money you're paying in is they're putting that to work, to some degree, I would think.
Yep. Yeah. And again, depending on the product, because if it's a variable universal life, a portion of that premium does go towards their cost of insurance, right?
Okay.
But they take that out before they put that into mutual funds, right? So that's just built into the overall design, and they know that they if they get you to point X, they're good. Like they already know the numbers, right? They have it all figured out,
right?
So they're insuring to that risk,
right? Okay. Yeah. That makes sense. That makes sense because they know, like, they have an expectation. They've been doing this for a while. They're not dumb. They know what they're going to make back, and historically they've made back in their investments and everything, and they can kind of figure it out from there. So, yeah, okay.
If you ever want to learn something kind of fun, you should look into the history of Warren Buffett and how he made his money, because it had to do with insurance.
Oh, really? Okay. Yeah. I know I took a big bet on American Express early on. Yep. I was here listening to a podcast. I told that story, and he was just like,
but that's a fun one worth looking into, just to see, like, with the way insurance works and the money that's accumulated and yada, yada, yada. There's a way that he was able to use that money and make more money.
Yeah, well, that's what you hope for.
Yeah.
So how does someone make that determination between? So I've got like most people, you've got a fixed amount a month, right? And I've got my bills I got to pay, but I also want to put some into my retirement, because I want to make sure I can do that someday. I want some into just, I want just kind of regular savings, as well. That's, available to me, if something happens, emergency funds, things like that, or I'm saving up to buy a new car, so I have, or down payment for a house or, whatever like that. So, but this just kind of becomes another one of those things, especially the permanent policies are more of a, you kind of, for me, I kind of lump it into that same kind of long-term bucket of, future financial.
You're saving that for someone else.
But yeah, not for me. Like, I mean, I'm hopefully going to be around to enjoy my retirement money.
Yep.
That's the goal. But yeah, this one, by definition, not so much.
Yeah.
Yeah.
Well, it really comes down to budgeting and what makes sense financially. Okay. It comes down to that. Because I think I've said before, you want to plan today, live today, but plan for tomorrow.
Yeah.
Right.
Yeah.
So we can't just have all our money going into life insurance and we don't have enough money to go out to movies and have some fun stuff. Right.
Right.
So it's just a balancing act of seeing what's most important of all these goals we have: emergency savings, of life insurance, of our retirement savings, of our fun bucket. Because I know someone's going to London soon.
Yeah, somebody is.
So Harry Potter world, it needs some of that money to be able to go have some fun.
Oh my gosh, do they ever? My daughter, I'm like, God, I love you, sweetheart.
Right, but that's the fun part. You have to have some fun along the way. You have to. Otherwise, what's the point?
Right.
So, go and enjoy that and have fun because you saved for it, right?
Mm-hmm.
That's the whole point.
Yeah.
But, how do we just see what the numbers, how's the budget shake out?
Right.
And that's what we usually try and go with, if that's the decision point
right.
that we have to make.
Nice.
And term will probably be the decision because it's just cost effective.
Right. Yeah.
At that point.
Yeah, that makes sense.
So,
but there are more options. And that's, again, why someone would want to, work with a financial advisor who has their best interest in heart to help you balance all this stuff.
There are a lot of insurance guys out there, but what I always tell all clients is to just be educated on it.
Right.
Right? Know the pros and cons, make sure that makes sense for you. Most insurance people don't know your financial situation well enough to even recommend something.
Right.
Right? So me as a financial planner, I do and can usually say, hey, here's our risk to your plan right here.
Right.
Let's fill this with some life insurance in the worst case scenario so we can protect this.
Right.
And that's what it comes down to.
Yeah. Well, that's one of the benefits of working with, like someone like yourself, like a certified financial planner, is that you are, you have somebody who's looking over the whole thing. I mean, and it can get a bit piecemeal. You're like, okay, I got this little piece over here and I'm talking to this insurance guy. And I'm not disparaging insurance guys, or people, or anything like that. But I mean, then it becomes my responsibility to then look at the whole and go, okay, like my employer offers a term that's this, and but I also have my retirement through my employer that looks like this, but then do I want to do an IRA over here? I mean, it can get daunting.
Yep. It can get very daunting.
Yeah.
So having that full picture look, having that 30,000 foot view, how does this fit into this whole thing? It's not just we can afford $200 a month. Let's get this product for you. You know what I mean? Like it's like the car payment. Oh, you can afford $200 a month. So let's get you that $200 car or whatever. You know what I mean? It's just about cash flow. And that's not the name of the game with me or any planner. It's really about how does this fit into the plan? How does this protect the downside? Because that's the point of this insurance, is to protect.
Right.
In a worst case scenario.
Yeah. Which is, again, that whole live for today, plan for tomorrow.
Yeah.
Which is, for the good and the bad.
Yes.
Hopefully we all get long lives and long retirements and money to enjoy it and, all of that, but maybe not. And, we have responsibilities that survive us.
Yeah.
So
So there's many different ways it can be used. It's, like I said, it's just a tool. Right. It could be debt management. It could be worst case scenario management. It could also be used for businesses to have what they call key man insurance, right? So let's say that you're a small business and you got someone working in your company that has invaluable knowledge about your company, right?
Okay.
And if you lost them tomorrow, you'd be in a world of hurt.
Oh, okay.
Right? So you put key man insurance on that person that in a worst case scenario, they passed away. You can go buy someone like them. Hey, person X down the street that works for the competitor, I'm going to pay you $100,000 bonus to come over here and work for me now.
Right.
And I can do that.
Right. Well, because I do think we often think about life insurance as something we basically take out on ourselves or, for our spouses for the benefit of that. But if you are, I think you and I talked about this personally, like if you're business partners who, may want to have insurance on each other.
Yeah.
Because if you're a business partner who you're probably not married to, or, maybe, but I mean, you're probably not married to have those kind of relationship with, you have a pretty important relationship with your business partner. And if something happens to them, today, tomorrow, 10 years from now, that's going to affect you. It'll affect them and their family, but it's also going to affect you and everyone who depends on you in your business.
Yep. So scenario just happened recently was I got two business partners, right? They've been in business 5 years.
Mm-hmm.
They've had great success. Okay. I asked them if they had an operating agreement for their business. No operating agreement. And I was like, they're both married. And I was like, if God forbid something happened to one of you, are you guys okay being in business with the other's wife? And they're like, well, it's just understood that, we'll buy them out. I'm like, but they don't legally have any reason they have to. They could legally say, the husband's gone and the brother's sister's uncle says, hey, don't sell that business. That's an asset.
Right.
And then now they don't want to sell it.
Right. Let's put your son in there, or,
Right. So now you're in business with not only the deceased spouse, you're now in business with the deceased spouse, friends and family,
right,
advising them on what. So anyways,
who all probably have opinions.
There are ways to protect against you. Number one, having an operating agreement that outlines that, but then number two, having what they call a buy-sell agreement as part of that. So
right.
God forbid something happened to either one of you, there's a force mechanism, a legal force mechanism that will allow that person's deceased spouse to be bought out.
Right.
Through maybe a lump sum of money and or a payment plan of some sort.
Right.
But a lot of times those can be funded from cash flow or life insurance.
So you can actually then layer a life insurance policy to make the lump sum payment or whatever the widow or the widower or the spouses do.
Yep. And let's say that the business grew in value over the period of time that you bought it. You do have to reevaluate it from time to time to see if you have enough coverage. And it's not always having it completely covered by the life insurance either, but just knowing that so that hey, we have a chunk of money down for down payment, and then we're going to have a cash flow on the rest of it, or you buy more insurance, which I've done for other businesses where they just buy more because they grew so much that they had to get some more insurance. But here's the cool thing about that convertible policy I was telling you about earlier, that it's a term insurance that's convertible. These guys have a plan for their business, and it's not for the next 30 years.
Okay.
But they're going to get a 30-year term that's convertible to the last day. What that means is the last day of the policy, they could convert it if they so chose.
Okay.
The reason is that they're going to own policies on each other. And then if they pass away in the worst case scenario, they're going to buy out the other one's spouse, right?
Right.
That's the worst case scenario. Best case scenario, let's say they sell the business in 7 to 10 years or whatever the number ends up being for them. They still have these policies, right? Well, they can reassign them to each other. So they can give the ownership from one person to another person.
Oh.
So now they can assume their own policies and take that with them onto their next whatever that happens for them. So it's their own personal policy that they still can convert it to the last day.
Right.
Or just let it run out of its term period if they wanted to.
Right.
But it gives them, I like to try and give people maximum choice and flexibility. I think it gives maximum choice and flexibility that if the worst case scenario happened and you became terminal, not going to live a long life, whatever it is, and you needed to convert it, you could.
Yeah.
And then you will always have that death benefit for your loved ones.
Yeah.
That's a pretty big deal.
Yeah. So I mean, these are not uncommon scenarios. People own businesses, and they own businesses with people and things like that. So this is one of those places where you can.
So it's another way that insurance though works to help. I mean, that's really a really good plan for these folks that, they're like, we can do that. Yeah, like, yeah. They were talking to their insurance person. They didn't know anything about them.
Right.
In regards to their goals and what they're doing and why they're doing it, their cash flow, their business valuation, like any of that stuff, right? They just don't ask those questions.
Well, it all comes back to the plan word, Roy.
It does.
The plan. All right.
It's all about planning, baby.
Yeah, planning's important. Well, and it doesn't take that long. I mean, you're not. I know you said the worst case scenario on this 8 months waiting for underwriting, but you're not investing. You're waiting, which stinks. But I mean, there's not a whole lot of time and effort and hours you have to put into it. It's just being thoughtful about making sure you actually think about it and find somebody who can help you think through it and work through it and
get
it done, get education and get the pieces done. And once it's done, then you go back and evaluate every once in a while, but then you got it.
You definitely sleep better knowing you got that protection for people you care about.
Oh man, absolutely.
That's
absolutely.
a big deal.
All right. Well, did we miss anything important about insurance, Roy?
I think that's the basis of what you need to start with is just understand that it's a tool. It's not one size fits all. It's not everybody does this or that. It's what do you personally have going on? What do you need and why do you need it? And then evaluate what kind of coverage you should have if you don't have some. But if you have, spouse, and especially if you have a stay-at-home spouse,
yeah,
you definitely need to have insurance. But people don't think about this though. The one that's staying home, they always get less insurance on. But worst case scenario happens, that worker isn't the one that passes away. It's the one that stays at home that passes away. Well, who's taking care of the kids?
Right.
Who's doing all that work that was being done? You still want to be debt-free, so you need to have that coverage. But then you still might want to build in some income replacement for maybe you got to hire some help for the kids after school for a couple hours every day until you get home from your job.
Yep.
Whatever it is. So stay-at-home parents are still needing to be insured just like a working parent.
Yeah. Yeah. Well, the number of ways that stay-at-home parents are undervalued is, legion at this point, but that's definitely one of them. Or
but that's probably the last takeaway is that just don't forget that that's important to have that too, because just because you have an earner doesn't mean that they're going to want to spend every penny on, taking care of the family that they didn't have to before.
Right.
And now they're sacrificing savings or emergency money or whatever.
Yeah. Well, if you think about it, a lot of times people become stay-at-home parents because of the cost of childcare.
Yeah.
Because childcare is so ridiculously expensive. That is oftentimes one of the biggest drivers for people to be home stay parents in the first place. Well, if you find yourself unexpectedly, without that stay-at-home parent and in the world of single parenting, childcare is still expensive.
$40,000 bill for your kids to go to daycare, right?
Yeah.
Like I just talked to someone this week about that.
Yeah.
So,
it's crazy.
It's crazy. So anyways, yeah. So educate yourself. Just talk to someone who actually knows your situation fully and make a good educated decision and just look at it as a unemotional. Do I need this? Why? How much coverage, etc., and just see what works for you.
Yeah, absolutely. Well, thank you, Roy. I really appreciate it. And again, not a conversation people are always necessarily lining up for because we got to deal with some stuff that maybe we don't want to deal with. But it is also life, and it is part and parcel of the whole thing. And if we've got responsibilities and responsible people, we want to take care of them and take care of the people we care about and love. And and what a nice gift. I have worked with families, over the years. I don't know how many dozens of times, around end of life stuff. And, when people find out that, someone so-and-so thought about something or they bought a policy for something or we're clearly thinking ahead of what they were leaving behind. It's just that last little gift of love, truthfully. It might sound corny, but it is. It's that last little gift of love to whoever it is, your kids, your grandkids, that organization you cared about. We've had people leave life insurance policies to the church before or, other nonprofits. It's that last little gift of saying, even though I'm gone, I still care. And, so here you go. I was thinking about you while I was alive and that's great. And it actually gives people comfort. It's like, oh, grandma, grandpa, Uncle Ted, whoever it is, was thinking about me, or thinking about this. And it's just, it's that there's some intangible benefits to it as well.
Yep. So, it's that simple. It's that important.
It is. All right. Well, thank you for this important topic.
Thank you.
I think it's something we all could learn a little bit more about, for sure. Take some time to educate ourselves. And so I thank you all for taking the time to join us to listen to what we got to say. And until we bring up, I'm sure, another wonderful and informative topic down the road, I want to thank everybody for joining us.
Yeah, thanks, everybody.
Please note the information provided is for informational purposes only and should not be considered personalized professional advice. Always consult with a qualified expert before making any decisions or taking any actions based on the information shared. Roy Hookey is an employee of Credentialed Wealth Advisors, LLC, an SEC registered investment advisor, and may maintain positions in the securities discussed. All opinions expressed are Roy's and do not necessarily reflect the opinion of CWA.